Most momentum and trends and patterns that we see in stocks and in stock market prices are statistical illusions. There's a penny flipping experiment in the book, if you read about it. If you flip a penny and record heads and tails and you chart it, +1 for heads, -1 for tails, you'll get a chart that looks like it has patterns, that looks like a stock, but it could all be the product of total random chance. Hey guys, Darren Wurz here. I hope you're doing well and hope that you're enjoying our book, A Random Walk Down Wall Street, this quarter. Wanted to just check in here with a quick take, my quick take on chapters 5 through 7, as Burton Malkiel goes through the two biggest ways that Wall Street has tried to beat the market historically: technical analysis and fundamental analysis. And I know it's heavy reading a little bit, so if you made it through, congratulations. But this book is written to be accessible to anyone, even if you don't have a lot of investing experience. That's okay. So I'm going to break it down for you. And if you didn't get to read those chapters, well, great, that's totally fine. Hopefully this will be sufficient for you. So there's two main ideas. There's two ways that professional investors have tried to achieve the best results, okay? The first is technical analysis. Technical analysis is basically looking for patterns in charts, looking for patterns in stock market price history, in stock price history for individual stocks. This relates very closely to the castles in the air theory. If you remember, we talked about this early on, the one of two theories on what's the true value of a stock, right? Technical analysis relies on the castles in the air theory. That is, fundamental numbers don't matter, data doesn't matter, revenue, profit, earnings don't matter. The only thing that matters is how does the crowd of investors view a stock, right? The only thing that matters is how other investors look at a stock, investor psychology. And so technical analysis tries to uncover investor psychology by looking at past movements in prices. Okay? Now, this appeals to our nature because we can look at charts and it looks like there's patterns, right? We can look at stock market squiggly lines and it looks like there are discernible movements, and you could almost predict where stock prices are going. Sometimes they move in a very nice linear fashion for a long period of time. But technical analysis largely does not work. And here's why. Three big reasons why. Number one, the person doing the technical analysis only buys the stock or recommends an action for a stock after a trend has already been established. The problem is sharp reversals can happen suddenly and without warning. The second thing is that technical analysis techniques are self-defeating. Now, technical analysis may have worked in years gone by, in decades past. However, as more and more people use these techniques, they become less effective. As more and more people anticipate stock market signals, they tend to work less and less effectively because more people start taking action earlier, and so they ultimately end up destroying themselves. The last thing is the profit maximizing behavior of market participants. Market participants want to maximize profit. If we think a stock is going to go to $40 tomorrow, there's no reason it can't go to $40 today, right? And so information materializes instantaneously, right? Before signals can even materialize, before information, as soon as information becomes public, stock prices change instantaneously almost. And so it's impossible to get an edge. The second way that we can try to invest is fundamental analysis. Now, fundamental analysis is much more respected by the Wall Street community, but it's as much astrology as technical analysis is. And here's why. I'll tell you why. Okay, so fundamental analysis is based on the firm foundations theory of stock valuation. This idea that stocks do have an intrinsic value that is knowable and that is calculable based on earnings and dividend growth. We can look at numbers and we can calculate. Now, it feels much more robust because it's much more mathematic. It seems like it's much more scientific, right? But there are three reasons, well, actually, four reasons why fundamental analysis does not work, and maybe works even less than technical analysis. Number one, the information analysis might not always be correct. Precise figures are difficult to obtain. Companies, publicly traded companies, put out adjusted financials. They put out adjusted earnings. And that means just that. Companies are adjusting their numbers based on one-time things that happen that shouldn't be recurring, charges to revenue that are abnormal. Okay, so how can we even begin if we don't have correct information? And that's part A. Part B, it can get even worse, is when companies actually cook their books. And we have seen this. Fraud exists. The second thing is that the analyst's estimate of value might be faulty because there are a lot of assumptions and expectations that go into fundamental analysis calculations. It's all based on expectations of future growth, which cannot be proven. Even worse, many analysts can be either lazy or error prone as human beings. And even worse, the fundamental analysis industry, the security analysis industry, right? And you'll see this all the time. You watch CNBC, ooh, JP Morgan has a price target of X on Y stock. Total bullshit, okay? And the bigger reason why this is often bullshit is because the analysis industry is tainted and influenced heavily by the investment banking industry, okay? The analysts don't want to piss off the investment banking clients, okay? So they're very, very hesitant to ever issue sell recommendations. By and large, most recommendations are buy recommendations. The third thing is that random events cannot be anticipated. COVID pandemic, the terrorist attacks in 2001, right? There are things that happen in this world that are random and that cannot be anticipated by fundamental analysis. And last and most importantly, no matter what you calculate the fundamental value of a company to be, there's no reason that the stock will ever converge. The stock may never converge upon true value. You have a stock that's $50 and maybe you calculate this stock to be worth actually $100. It may never, the public may never appreciate it for what you think it's truly worth or what fundamental analysis may say it's truly worth. So is it really useful? Not necessarily. Some of these tactics may have worked in the past, and they did decades ago when markets were not as public, when disclosure laws didn't exist. But now these things are self-defeating. One famous strategy is called the dogs of the Dow. The dogs of the Dow strategy buys the highest dividend yielding stocks in the Dow. Used to work, doesn't work anymore because too many market participants started taking advantage of it. And if too many participants take advantage of something, it no longer functions as an exploitative inefficiency in markets. The bigger point is, over time, markets have become more and more efficient, right? So inefficiencies are more difficult to discover. Is there really momentum in the market? Yes and no. Markets are definitely influenced by the crowd of human investors and investor psychology, but it's our human psychology to look for patterns, right? It's our survival instinct, our ancestral survival instinct to look for patterns. And so we're prone to look for patterns in markets, and we're prone to find patterns where none exist. Most momentum and trends and patterns that we see in stocks and in stock market prices are statistical illusions. There's a penny flipping experiment in the book, if you read about it. If you flip a penny, and you record heads and tails, and you chart it, +1 for heads, -1 for tails, you'll get a chart that looks like it has patterns, that looks like a stock, right? But it could all be the product of total random chance. There are other examples. There's a Super Bowl indicator that seems to be very accurate. The two conferences, I forget the names. I'm not a big football person, but um, based on who wins, which conference wins, right, tends to correlate very well with markets. But this just proves that totally random events can be correlated with markets and may be completely wrong, right? The real risk in timing the market and trying to pick stocks is that you'll miss the truly generous returns that markets provide. The bigger lesson here is that we want to own the broad market through broad market index funds that are passively managed. This is why actively managed funds should be avoided. The average equity mutual fund underperforms the market by 1% a year. That's huge over time. 94% of large cap equity funds underperform their benchmarks over a 20-year period. The hot funds of last decade are usually the worst performers of this decade. That is something we can see. Probability explains why some funds outperform. The number of funds that actually do outperform is consistent with statistical random chance, right? We would expect the same number based on a bell curve distribution. We would expect the same number of funds to outperform, which is a very small fraction. Identifying who those are going to be is impossible. The conclusion is the efficient market hypothesis. The efficient market hypothesis basically says the markets are so efficient that you can't beat the market either by knowing information through fundamental analysis or by looking at patterns and trying to discern where prices are going to move next. Corollary to it is the random walk hypothesis. The random walk hypothesis is that stock market prices follow a random walk over time, resembling the steps of a drunken man walking home, right? They have no discernible pattern day to day, okay? There are three versions of this. And the first is the basic form is that looking at past prices can't help you. But then there are stronger forms as well, and that is that public information can't help you either. There's the strong form of EMH, efficient market hypothesis, which says that nothing at all ever knowable can help investors. That might be a little bit too far to take it. The biggest lesson here is that purchasing a broad stock market index will do as well as anything managed by a professional. It doesn't imply that stock prices are always correct. In fact, stock prices are almost always incorrect. In fact, they're always incorrect. But it's impossible to know whether they're too high or too low and what correct actually is. So, hope that was helpful for you. Demystifying a little bit of the world of stock market investing and what works and what doesn't work. And unfortunately, trying to beat the market might be a fun game to play, but it is highly unlikely to be profitable. All right, we're on now to the next chapters on modern portfolio theory and how to turn this into actual practical advice for you in building your portfolio in the next half of the book. I look forward to seeing you here in the community and at our upcoming events.